Well, welcome to Women on Wealth, and we have a very timely topic today, given what has transpired with interest rates here in 2022 and the effect that it's had on mortgage rates. So we are going to talk about the lending landscape, and we're actually going to do it in 3 series. Today is the first, which is going to be mortgage interest rates. And to have this discussion, I'm excited to have Anna DeSimone, who is author of Live in a Home That Pays You Back, all about getting the absolute most out of your home. She's also authored Welcome to Agrihood and Housing Finance 2020, and has written more than 40 best practice handbooks for finance industry professionals on the topic of fair and responsible lending. So Anna, welcome.
Oh, thank you. Thank you.
Let's talk about the interest rates today. Just as a backdrop, I was taking a look at this, and this is all according to Freddie Mac. If you look at a 30-year mortgage, the average rate coming out of the financial crisis was around 4%. And it went as far down as maybe 2.7 at the end of 2020 during the pandemic. And all year long this year, we're in the fall of 2022, we have watched the Federal Reserve raise interest rates. They've raised it 3 times by 0.75%, very aggressive. And that in turn has affected mortgage rates, which are now over 6%. Is that a good summary?
Yes. Yeah.
So that's a pretty aggressive change. It's almost double the increase in less than a year. And that's why I'm so excited to have you on today, because what do you do as a consumer if you want to buy a home, refinance a home? What do you do with mortgage rates?
I know. That's a big question. And
that's a loaded introduction.
I know. And you know what's funny? I thought about this and I thought it's like, I'm just going to rip the Band-Aid off and I'm going to say it out loud. Interest rates are the highest they have been in 16 years right now. Mortgage for home mortgages. And if you look at a 15-month history, they have practically tripled. And
wow.
That's kind of sad. And so I'm glad that this is the first of our series, Julina, because we got to get the bad news over with. Interest rates are depressing right now. Yeah. However, I would like to share some really good news. Now,
that would be great.
The second part of our series, we're really going to dig deeply into property values and the appreciation rates in America. Mm-hmm. And we are also lucky to be in New England. We're very lucky to be in the state of Connecticut. And next week, in our next podcast, we'll be talking about how much equity you have in your home because you live in the state of Connecticut.
Sure.
And, we're not alone, because across the entire United States right now, the average homeowner in America is sitting on about $113,000 worth of home equity that they have accumulated in the past 36 months.
That's amazing.
And keep in mind, the average house in America is like $360,000.
Right.
And so, being in Connecticut, we have a little bit more home equity.
And interestingly enough, we had our monthly investment committee at our firm yesterday, and we were looking at the appreciation values across the country. And I think, to your point, it's not just Connecticut. There were areas of the country that surprised me that were still appreciated relative to where they've been.
Oh, the entire country. And now, if we were having this conversation 3 or 3.5 years ago, prior to the pandemic, we would be talking about why are real estate values going up? And so throughout the pandemic and right up to today, the property values of homes continue to go up. But the reason for this actually started about 4 or 5 years ago. And the 2 most important drivers of real estate values going up are new construction and the lack of people that we have doing construction work. Of course, general economics as well, mobility of people going in, right, they're going in and out. But about 3 years ago, so the statistics in 2019, according to the Harvard University Joint Center for Housing Studies, In the spring of 2019, so it's pre-pandemic, the United States was lagging behind approximately 500,000 homes across the nation, which meant that there was a slowdown in new construction. And so when you're thinking about, why are homes just keep going up in value? Well, it's supply and demand. And so the reason why the new construction had slowed down were because of the new environmental standards and the building standards that were being put into construction. Plus, we had a shortage of wood, lumber, and we had a shortage of workers that could be building homes.
It was like a trifecta.
Yeah, it was a trifecta. And now now that shortage has loosened up a little bit. There are more, the lag time isn't so long, but the reason for that has a lot to do with the fact that the millions and millions of homes now are being not completely built in a factory or an offsite location, but they're being partially built. So those are called prefabricated homes. And they're fantastic, not only for environmental reasons, because they're made with sustainable material, but the turnaround time for construction, instead of taking a whole year to custom build it, what we call a stick-built house, if you can get a fully or partially prefabricated homes, as we know as modular homes, which happen to be architecturally beautiful, it can be done in like 4 months.
Wow, that's a big difference.
Yeah.
Yeah.
So what do people do today when they want to buy a house? I mean, the average home being $360,000.
Right.
What are they going to do? Well, I wanted to just talk about numbers a little bit. Yes, it's true. The interest rates are horrible. They're 7%. But I would like to just give a little bit of an overview about the mortgage lending process today and how it's affecting women, especially single heads of household women. I mean, because according to a study by Freddie Mac, 3 in 10 single women that are currently renting don't think that they can afford a home. So I do want to give you some good news on how and why single heads of household can afford a home. The interest rate programs that you see when you're shopping online for a mortgage come from 2 sources, because everyone goes online. They're looking
Sure.
So what you're seeing when you go on the internet are 2 things: advertisers and aggregators. And so, Juliana, you know what aggregators are. You could probably explain it better than me, but that's when you get a marketing company that is representing a lot of different lenders. I don't want to mention any names because there's some very common ones out there, but everyone is shopping for the best rate for you.
Right.
But here's the problem with that is the aggregators and all of the interest rate programs that you see advertised on the internet, when you're trying to get pre-qualified to see if you can get a mortgage, they're asking you information, they're information gathering. What do you think your credit score is? What is your monthly income? And how much you're putting down on your home? And so the algorithm that pre-qualifies consumers for a mortgage is based on 3 criteria: your credit score, your monthly income, annual income. The algorithm is going to divide it by 12. Your credit score and the down payment, which we will call the home equity. But the problem with that algorithm is it is only able to take into an account people who have had the same job for the past 5 years. They earn a flat salary or wages. Or if you have 2 people buying a home together, they may both be qualified, have salary jobs.
So Anne, if you're a female entrepreneur, right, with a business that has that fluctuating income stream, that makes it a lot more of a challenge.
Well, yeah, because the algorithm cannot address the needs of people who have income that is irregular. It's from a variety of sources. The algorithm isn't going to pick up whether or not some of your funds are borrowed or some of your funds are coming from a family member in the form of a gift.
Right.
Now, what people don't realize is that 30% of Americans have non-salaried income. So we have people that have 1099, their income is sometimes seasonal, they're working odd hours, they're independent contractors, or they're self-employed.
Right.
And because for the most part, and not in every case, but as a general rule, single heads of households tend to be females because not only are they breadwinners, they are also caregivers. And so then you're more apt to see people who are working, nurses who are working different shifts because they can get a family member to take care of their young children, during the day, or they can spend time with their kids. And so they're working, different types of jobs, and their income sources may include alimony, it may include child support. And sometimes the down payment sources may be a combination of borrowing from a 401k,
Absolutely.
be a gift. And so what I would like to announce on this podcast is, in as much as the internet is the most common source of shopping for rates,
Right.
that isn't where you're going to find the secrets, because the secrets of mortgage lending are from the nonprofit world. They're not advertised, so you're not going to see them advertised on the interest rate. And so the average home buyer is coming in with 10% down across the nation. So if you're looking at a home for $400,000, you still have to have $40,000 in cash, and maybe $5,000 to $8,000 for closing costs.
Of course.
What people don't realize is that every single state in America has a housing partnership agency. The state of Connecticut has the Connecticut Housing Partnership Agency and Authority. Massachusetts has a housing partnership agency. And a lot of professionals in the industry, including realtors and a lot of people that are even in the mortgage industry, they are sometimes misinformed, and they think, well, the nonprofits and the local partnership agencies are for low-income people. Well, when I wrote my book, Housing Finance 2020, of course, I was in the websites, deep into the weeds of the programs, but every single housing partnership agency in America. And I can tell you that every single agency has programs for families households earning more than $100,000, except 6 states in America, like Arkansas or Mississippi.
Okay.
Like over 45 states that you can earn over $100,000. Well, here's the other thing is all of these partnership agencies deal with Fannie Mae and Freddie Mac and the VA and the FHA, which means that you're going to be getting the same mortgage program that would be offered by a credit union, a local bank, or a mortgage lender.
So interesting. Okay.
But because they're state chartered, they are structured and designed around municipal bonds that are created by the state or the municipality. So on a smaller level, like a local housing partnership agency would be serving, say, Fairfield County. It would be serving Middlesex County. And the charter of the local partnership agencies is to meet the credit needs of the people who live in that county. But on a statewide basis, what you'll see is down payment assistance programs, closing cost payments, and I am talking 0% loans. So in as much as we are in an environment where interest rates are bouncing around from 4 to 7% over the same quarter, as you've seen yourself, what people don't realize is that down payment assistance programs are so exotic, they're so flexible, they're like a dream come true for people. There are programs that will give you as much as $20,000 to put down on a house. The different types of repayment is, well, a 0% are often secured for the life of your mortgage. So if you get a 30-year mortgage, you don't have to make any payment on that program until you refinance or sell your home.
Okay.
It's there. That's called like a silent second. And then there are other programs that are called step payment plans are forgivable. Now, in the lower income areas of people that are making under $100,000, there are forgivable loan programs. So the Housing Partnership Agency will provide the home buyer with $10,000 or $15,000. And each year that they live in the home, a certain portion of that loan is forgivable.
Okay.
No, I mean, that's a whole new world that people are not seeing when they're shopping online.
No, absolutely. Because your point when you started this is that that is being driven by all of the aggregators that are paying for advertising. These nonprofits are not doing that. You have to go find them.
You have to find them, and you have to Google your way through the town that you live in. And, in the real estate industry, one of the most common phrases is, everything is local, location, location, location. And the piece of advice that I like to give people is if you are looking in the town of Madison, Connecticut, if you are looking in the town of Old Saybrook, if you are looking in the town of Westport, you have to think of the town website as like the coupon clicking of your mortgage.
Sure.
Because if you're a senior citizen, there are low interest programs, there are energy efficient programs. If you're a veteran or an active military, if you're a qualified spouse or a veteran, every town and municipal office in America has a housing division, which you could just click into when you're on the website.
And Anna, how long have these divisions been around? This is clearly not something that was created just because interest rates have been driven up over the last few months.
Forever. It's like when you're like, if you live in a town and you want to put an addition on your house, you'll say, I wonder how many feet the addition has to be from the side. I think I'll go on the town website and go in the building department, the housing department, and find out what the rules is, or do I need a permit? And what you're surprised to find out is there are heating, fuel assistance programs. There are low interest or zero interest improvement loans that may be qualified for certain people like seniors or people that have a handicapped member in their household. But not always. You'll see first-time home buyer assistance. You'll see special programs for people who want to refinance to make certain safety improvements, put a handicap rail. But what I'm saying is you're going to learn a lot about the town where you're thinking about living.
Absolutely.
Once you go to their website, you're going to see what they're giving back to the community. Part about buying your first home is asking yourself, is my family and I, we're going to be happy here?
Yeah.
Are we buying in the right place? Are we paying the right price? What are we going to get out of this town? What happens in case of an emergency? And looking at real homes online through the multiple listing is something that's natural. Everyone is doing that all of the time and shopping for interest rates. But you have to kind of start thinking local.
Sure.
What is this town or city giving back to me?
Yeah. And as someone that moved myself a few years ago, these are all questions that typically arise when you're considering moving to a town that you may not know as well as the one you're currently in.
That's absolutely right. And especially, there are a lot of people are buying their first home when they have children.
Sure.
And, real estate people and real estate listings are always saying, highly rated school district, top rated school district, the kids that went to the school, 94% got, very high SAT scores. And you know what? Not every child thrives in a highly competitive school district. Sometimes people know their children, and if you think that your child would thrive and do better in an outlier community, when I say an outlier community, maybe it's not boasting the highest scores or the highest prices, but it's a walkable community, and it's one of those communities where you see a lot of people at the little league games, and you really get a comfortable feeling there. And if you think that your family or your children would be happy there, then that is the place you want to be.
Sure.
And, so speaking, that segues into how much can people borrow
Yeah.
with rates going up.
Yeah, exactly.
Okay.
Exactly. And there's concern that, that process is going to change as well. I don't know if you have any insight into that.
But here's the thing, Julina, Principal Wealth Partners, I mean, your whole life is about taking the money that people have and not putting all their eggs in one basket, diversify, right? But when we think of our mortgage, I think it's only natural for us to think that one price fits all.
Mhm.
That we have to get the lowest, absolute lowest rate. And it's going to be a 30-year fixed. But remember, the average length that people live in their homes actually in America is like 7.5 or 8 years. Mortgages turn around. And so I have one word of advice for buying a home in this particular volatile interest rate market. And that word is be flexible. Have to be nimble. And so try to think of the mortgage on your house as not being a one size fits all. So I'm going to give you a little bit of an example. If you were borrowing $300,000 right now at 7%, your principal and interest payment would be $2,000 a month.
Yep.
If you happen to get a rate at 6%, it would be $1,800 a month, which is $200 less.
Yeah.
And if you happen to get a rate of 5%, it would be $1,600 a month, which is $200 less. Now, $300,000 is very close to the national average. And so I can tell you that if you were buying a home that is worth $400,000, each year that you are living in that house, you are really adding $50,000 to the equity in your home.
Yeah.
More than that, more like 70,000. Okay.
So it's amazing.
So the price of homes is not going down. There are certain rare instances where certain economic factors and employment factors will drive prices downward.
Mhm.
We are not in a bubble right now. We are in a supply and demand. There's only, so many homes, and the new construction cannot keep up with the demand. So anyone who's buying a home right now needs to ask themselves, is it worth me taking the risk to spend $2,400 more per year to borrow $300,000 at this high rate of 7%?
Exactly.
If I have an opportunity to buy a house that is going up in value $50,000, $60,000, $70,000 a year.
Yeah. And I think to your point about being flexible, again, we're at an interesting point from an economic perspective about everyone. The markets are trying to decide how much further the Fed is going to go. How far are they going to raise interest rates? Are they going to take us into a recession? Are we in a recession? And oh, by the way, if that's the case, are they going to start cutting rates? And if that's the case, then that 7% mortgage rate then starts falling. I don't know if it'll go back to an all-time low, but even if it goes back to do you think it could possibly go back to the 4% average that we've seen?
Yes, because I have been, doing my own studies, like for the past 40 or 50 years, and this should come as no surprise, but politics does play a part as to where the rates are during a presidential campaign. Mm-hmm. Because I used to teach at a banking college in Boston, and I gave my students an assignment once to look at the rates before the presidential election, starting with Eisenhower all the way up to Clinton.
Oh, wow.
And they got a kick out of it. And they formed groups of 3 or 4 people, and they came back a week later for class and said, you're right. The week before the election, they were always at their lowest.
Yeah.
Now, remember, in those days, the lowest meant 7 or 8%.
Yeah.
During the Carter administration at the time, interest rates were, jumping from 12 to, 19%.
Double digits, yeah.
But what I'm saying is you have to buy your house now and get a mortgage to get in there, get your foot in the door.
Mhm.
But these are the things that you want to look for, the red flags. Okay, so you want to imagine yourself refinancing in 2 years, maybe 3 years.
Okay.
And refinancing costs money. And so one of the things that you want to look for in a rate right now, not just the lowest rate, but it is not worth paying points. Because whether you borrow $100,000 or $500,000, the rule of thumb with points is it takes approximately 5 years to recoup the amount of money you put in for points.
Great point.
On a $100,000 loan, a point is $1,000. So if you're borrowing $500,000, that would be $5,000 for 1 point. And the mortgage lender will say, well, our rates are 7%, but you can bring the rate down to 6.5% if you cough up $8,000 or $10,000 in points.
Correct.
And if you're going to refinance in 10 years, you've lost that money. Now, points are, have tax advantages depending on what tax rate you're in. So I would like to suggest that you ask the seller of the house you're buying to pay the points, because if they pay the points, it's more cash for you to put in your down payment and toward the closing costs. And they can't deduct them as a regular standard deduction on their tax returns. However, they are shrinking the cost basis of their home.
Correct.
And they're let's face it, they are making a profit on their house. Even if they lived in this house for only 3 or 4 years, they are making a profit.
Right.
And unless they can document doing a lot of work and improvements on the house, when they file their taxes, they're going to have a cost basis which compares when they bought it to when they sold it. And so that is a way to get the rate down. It's called a buy down.
Okay.
So the rate is incrementally bought down. Figure every point will buy you between 1/8 and 1/4%. Make sure there's no seasoning requirement or prepayment penalty. So what a prepayment penalty is that you can, in the old days when interest rates were really high in the teens, there were mortgages that had prepayment penalties that amounted to 6 months interest.
That's amazing.
So let's say you're paying $2,000 a month, and that is 99% interest.
Right.
You decide to refinance a year later, a couple later. That is the equivalent of $24,000 prepayment penalty fee. Now, who's going to have that kind of money?
Right.
To pay a prepayment penalty if you've only lived in your house for a couple of years.
Exactly.
So, thanks to the Consumer Financial Protection Bureau and a lot of overseers and bank regulators, you won't see too many prepayment penalties now. But when interest rates climb up, the exotic mortgages tend to find their way out on the market again. You're going to have a start rate or a teaser rate of 3% or 4%, but the loan, if it's legal in the state, could have negative amortization.
Absolutely.
Negative amortization means you're paying 3 or 4% as a true payment, but the underlying interest rate is really 7 or 8%.
Yeah.
So the other part of the payment that you're not paying is being padded on your outstanding principal balance. That's called negative amortization.
Thank you for clarifying that. And you really have to read the fine print in any environment, especially as we are in this higher rate environment. And if we stay here, then we're going to start to see more of these types of loans, correct?
Yes, they're going to come out of the woodwork. Now, what seasoning is, is how long you have had the mortgage before you refinance it.
Okay.
I can't, it's an old rule that says we want to make sure you made the payments on time. But if you could be buying your second home, you could be spending $700,000 or $800,000 for a move up house,
Mhm.
in your other house for 20 years, and you never made a payment late, and you've got a really high credit score. If you're getting a new mortgage on the house that you're now buying, and there's a seasoning requirement, that has to do with the secondary market investor. It's not the bank that you're dealing with or the mortgage lender that's just putting this on as a deal sweetener for themselves. It's
Okay.
because, as you know, Jelena, the mortgages are bought and sold in the mortgage-backed securities industry, and they're securitized by Ginnie Mae, and they end up on Wall Street. And when a bank or a mortgage lender is issuing a bond or commitment with a seal of approval or a government guarantee like Ginnie Mae, that is always going to be your cheapest and best mortgage.
Mhm.
Ginnie Mae guarantee, because the full faith and credit of the United States government is sitting behind the security of that loan.
Right.
The lender needs time to transfer servicing. The lender needs time to get this loan out to the quality control and the compliance examiners. Sometimes if there's something wrong with a loan, the servicer or the lender isn't going to find out for 3 or 4 months. And so the reason for seasoning isn't because the Fannie Mae or Freddie Mac doesn't believe that the borrower isn't going to make their payments on time. It's
Mhm.
just that it's going to sit in the industry a little bit before it gets paid off, because it's an unexpected shock to the mortgage-backed securities industry to all of a sudden have half their portfolio paid off because rates
Exactly.
dropped.
Yeah. And,
So,
oh, go ahead. Keep going.
so you want to find out, does it have seasoning? Does it have a prepayment penalty? And if it's an adjustable rate mortgage, which can actually be a very good thing right now in this market,
Yeah.
about what the period caps are and the life cap.
Okay.
So if it's a 1-year adjustable, you'll have a 2% cap probably every year. If it's a 3-year adjustable, you'll have a 2% cap every 3 years and a life cap of 5%.
And does the cap go in both directions?
Well, that's a great question. I forget to mention this. Most mortgages have both a floor and a ceiling.
Okay.
But exotic mortgages are the non-conforming mortgages, as we say.
Mhm.
Sometimes we'll have a ceiling, but it won't have a floor, which means it can go up, but it can't go down.
Okay.
Your start rate is 4%, and all of a sudden the treasury bill drops to 2 or 1 or 3. Your rate will never go below the start rate.
Okay.
So start rates are also known as teaser rate. But I also want to say that a good mortgage to get right now is a 10-year interest-only loan,
Mhm.
because it gives you so much flexibility.
Right.
These are non-conforming loans. They give you flexibility because there's no exotic features, what we call scare features, surprise, shock features, no
Sure.
prepayment penalty. You can refinance anytime.
And then you have the flexibility every month to decide how much to pay down.
No, yeah, you can add principal payments, but when you get an interest-only loan, you are actually locked into a 30-year fixed rate.
Okay.
So if the conforming rate right now for an amortizing 30-year fixed is 7%,
Mhm.
your lender might say, well, why don't you get an interest-only loan at 6%? And you're thinking, is that a good thing or a bad thing?
Yeah.
Well, the first 3 years that you live in that house, you're not really paying much principal anyway.
Right.
99.4%.
Okay. Yeah.
So it's always wise in every single mortgage program that you're looking at to look at the amortizations table. And I want to go back to that. Pretend you're going to refinance in 3 years.
Mhm.
So if you get an interest-only loan, you get a really good rate. You get flexible terms, so you can stay nimble.
Mhm.
And when you compare it to the 7% loan or 1-year adjustable or 3-year adjustable, what you want to focus on is, what am I going to owe in 24 months? What am I going to owe in 36 months?
Sure.
So if you're saving $100 a month now, you know that at the end of the year, you've saved $1,200.
Mhm.
So at the end of 3 years, you've saved $3,600. But the true worth of that mortgage is really about, what is the amortization of it? And if the amortization is so minimal, you might
Mhm.
get an interest-only mortgage. But I have to say that after 5 or 10 years, you're depriving yourself of the chance to build up any equity. But that is easily remedied by, when you making a mortgage payment every month and adding an
Yeah.
extra $500 or $1,000. It's a great way, if you can afford it.
Yeah.
It's a great way to be debt-free in 10 or 15 years.
Absolutely.
Also, those
It-
loans don't always have a lot of points.
Okay. Yep. Thank you for saying that. Is it fair to say, Anna, with the interest only, that you're thinking about it more as a solution short term, not necessarily as the longer term solution, just given where we are today?
I think the correct answer is, it depends on how much money you have and what stage of life you are.
Fair.
So if you're a first-time home buyer, I don't think I'd be recommending that. I would recommend a 7-year adjustable
Okay.
or a 5-year adjustable to a first-time home buyer.
Okay.
Because a lot of first-time home buyers have toddlers, and they're right now, we have a 2-income family, or maybe somebody's taking more time to take care of the kids. And the conversations that take place, with these home buyers are usually, well, in 5 years, my youngest child is going to be in 1st grade and I'm going back full-time to the workforce. This is very common. And
Yeah.
so people who are buying their first homes generally tend to have more of a game plan in mind about where they're going to be in 3 years, 5 years, or 7 years.
Mm-hmm.
Sometimes they already know they're going to move to a move-up house.
Yeah.
Although when starter homes cost under $100,000, 15 years ago, people bought starter homes.
Yeah.
And then they bought a move-up house. But
Yeah.
today, because of the housing prices being the way they are, people are buying what's called the home for life, the home of a
Okay.
life. And it's really important to make sure that you can talk to an architect to find out if you can expand that house.
Okay.
Because sometimes
Yeah.
what's affordable may not be big enough for a growing family. But the stage of life person that would be suitable for an interest-only loan would be a baby boomer,
Okay.
a retiree, because, you're thinking, if you're in your 60s and your 70s, you don't want to take money out of the bank to buy your, what we call, downsize or retirement home.
Sure.
You want to keep your money in the bank, but you don't want to pay all cash for your house. Or maybe you took cash out of the home that you sold, but it wasn't enough to buy your dream retirement home.
Yeah.
But you might be in a position to pay off that interest-only loan in 10 years,
Okay.
depending on how you manage your wealth. And this also works better for the higher net worth individuals.
Okay. Yeah. Thank you for going through that. What about refinancing?
Yeah, well, refinancing now, if you're looking to do a lot of home improvement and it is the last resort,
Mm-hmm.
you need $50,000 or $80,000 to put an addition on your house. And your house is going up in value, so why not? You're going to get the money back.
Right.
Let's face it, you're never going to have that 4% mortgage again. But I have a suggestion for you. I know that a lot of people are doing this, so it's nothing new. But if you have a low interest mortgage with 15 or 17 years left, you are at that point where you are getting a rapid principal payoff. So go look at your amortization schedule.
Okay.
And see how rapidly that loan balance is declining. And so that needs to be part of your analysis. So I'd like to suggest that you get a home equity line of credit to do the repairs or renovations on your house.
Okay.
And the reason why I'm suggesting this is your local community bank has the best deals right now. First of all, this is your where you keep your checking and your savings account. And they are going to offer you a program, which I think is too good to be true, really tiny monthly payments on a home equity loan.
Okay.
So many different payment options, such as interest only for the first 10 years. But
Yeah.
community banks are, even the regional, mid-sized banks, like $1 billion in assets and up. I mean, they're all doing the same thing because they're competing with each other.
Sure.
They want your business, and what's important to them is the value of your house. So if you're living in a home that's worth $700,000 or $800,000, you have an outstanding balance of an older mortgage of $200,000 or $300,000. By all means, do a line by line, dollar for dollar comparison of not only what your monthly payment would be now, but what your outstanding balances will be on both liens down the road in 3 or 5 year increments. It's so flexible. And a home equity line, you don't have to spend all the money. You can just, they'll give you a checking account. I mean, a checkbook, and say, you just draw on it when you need it.
Exactly. But it's coming back to the local community again. I'm sensing a theme here.
Well, first of all, the interest on a home equity loan is tax deductible, but I have to say there's a caveat there. There are certain sub questions that an accountant will ask about whether or not you're doing any improvements to the house.
Okay.
So
Sure.
it's but basically the interest should be tax deductible.
And what about people who are looking to downsize?
I did that myself.
This seems to be very popular with the baby boomer generation right now, right?
I did that myself.
Yeah.
And Habitat for Humanity will be your best friend. You really need to think carefully about how much space you really need, how much stuff you really need. It can be very emotional for some people.
Oh, of course. Yeah.
In my case, it was tough because I had 2 homes. Well, one was an apartment in Manhattan, and it was hard to give up my pied-à-terre. But I will tell you that it's been a lot more fun enjoying the city that I live in. I'm not bouncing back and forth from 2 different places.
Yeah.
But I think that when you are of retirement age, it is very important to have investments and money in the bank. But the home equity in your home is also your retirement nest egg. And so what appears to be glamorous in the retirement years, like having a house in Florida, with a lanai and a pool and all of that. And if it's a huge house and you're wondering where your family is and why they're not visiting you, it's because people are busy. And it's the same in the home that you live in. And my daughter and I have this joke that as long as there are hotels with swimming pools and resort communities, we don't have to worry about getting together for the holidays.
Yeah.
Because grandma doesn't have to cook all the time. And we found that kids love to swim.
That's the first question everywhere we go.
Yeah. Is there a pool? And I think that you can actually enjoy the holidays. I'm not talking about the really big holidays where you have it sitting around a tree and opening presents, but family gatherings and reunions are wonderful in resort communities. But the guest rooms, when people have 3 guest rooms in a 4,000 or 5,000 square foot house, from an energy saving standpoint, according to the Department of Energy,
oh goodness,
50% of the energy in America is being wasted on empty rooms. And so you've got property taxes, upkeep, maintenance. And I say take the equity out of that home, put it into an investment account and live in a home that is more maintenance free. has more walkability, has public transportation, and is located where people can visit you.
Yeah.
Because, people and your family can't always hop on a plane to come and visit you all of the time. And I think these are the problems that a lot of the baby boomer generation, which is probably the second largest home buying segment right now in America, is they want everyone to come to them.
Absolutely.
And
Yeah. And this is a hard one because this is not pure financially driven. I'm going through this right now with in my family, talking to my dad about whether or not he's going to sell his home and downsize. And this is not financially driven. It's really been more of an emotional decision.
I think it breaks down is, what are the little things that you do every day?
And are there any final considerations in terms of programs that that people should be looking at if they're in this situation?
Well, there are people who are surprised when they find out they can't qualify for a mortgage when they're retired.
Okay.
And so it's not easy. I mean, you're living on, maybe Social Security and a small amount of dividend income.
Yeah.
And you're thinking, well, I have a chance to buy a home in a dream community, and it's my retirement is perfect if I can get this house, but I need a couple $100,000 mortgage. Okay. There are two programs that I can mention. They're a little complicated, but for people over 65, one is a reverse mortgage. And the older you are, the more money you can get. So, quick rule of thumb, if you're in your 60s, you could probably get a reverse mortgage for approximately 20 or 30% of the value of the house. So if the house is worth $600,000, you could get a reverse mortgage for $200,000.
Right.
If you're 75, you could almost double that. You could get 450 out of 600,000.
Mm-hmm.
And if you are 85, you could get practically the whole thing paid for, 600,000.
Yeah.
These are government insured. There's two types of programs: the government insured, which is the FHA. It's called a HECM. Of course, if not everyone has perfect credit. I mean, everyone has gone through different problems with their life, and maybe there are many reasons why someone had a bankruptcy or foreclosure or had a credit issue.
Right.
That is not a problem with a reverse mortgage.
Okay.
They only do a credit report to see if you defaulted on a government loan. That's all.
Yeah.
And it's part of the identity theft thing too, and being a U.S. citizen. But you can have poor credit and get a reverse mortgage. You don't need any income. You don't even need to have Social Security.
Right. And I have to ask, Anna, when I think of reverse mortgages, I think of the financial crisis with the housing crisis, and these reverse mortgages that created these issues. What's changed? What's the difference between now and then, in your opinion?
Well, real estate value has been stronger.
Yeah.
But there's two things: there's federal compliance, federal rules, and then there's state compliance also. There was a lot of misinformation that was being spread in the reverse mortgage world. There's a couple of things about reverse mortgages that are very, very good. One is the income is not taxable.
Okay.
Because technically it's a loan, it's not taxable. Secondly, under a government insured program like the FHA program, even if your house goes down in value,
Mm-hmm.
you cannot lose your home. And so every child and grandchild of a parent or grandparent that's taken out a reverse mortgage worries about this. Well,
Sure.
what happens? The house is appraised for $200,000.
Yeah.
We get $100,000 or $150,000 reverse mortgage. 15 years later, grandma's still in the house, but the economy is so bad where she lives, the market's gone down.
Yeah.
The heirs will never have to pay a penny.
Okay.
Of the losses. And so it's really about getting the facts and information and being educated.
Yes.
A reverse mortgage can keep people from losing the home that they're that they're happy in and keeping them comfortable.
Yeah.
And, some studies have shown that people, if they're so attached to their home, they will be happier and healthier if they just stay in there.
Right.
And reverse mortgage enables that. It's
Okay.
also used in the high wealth area because it can be used for generation skipping and to defer taxes.
Yeah.
Estate taxes on the part of the heirs. And so people that have a $6 or $8 million mansion,
Yeah.
and they want to stay in it, but they want to help, they want to give a gift ahead of time to their families, their heirs.
Mhm.
Reverse mortgage can be a very useful tax tool.
Right.
Yeah.
Thank you for going through all that, because the topic today is just so overwhelming. There's so much information. And to your point, you're not getting all the information if you're Googling it. So what I got out of this today was Google your way through your town. I don't think I've done that enough. And so Anna, where can we find you? I know you're going to come back for 2 more sessions, which I'm so excited about. We're going to talk about real estate values. And then we're going to talk about going green. I'm kind of consolidating it, but there are going to be 2 great follow-ups to today. So thank you.
And where people can find me, you can Google me.
I guess that's
DeSimone.net or on Amazon. I have several books up on Amazon about housing finance.
That's a good way to end. That's great. Well, thank you so much, Anna. And I look forward to you coming back.
Thanks. Look forward to our next session. Take care, Julina.